Let us now talk about investing in non-domestic equities. And this essentially means investing in stocks of companies that are outside our home market or outside our domestic market. First, let's go over a few basic definitions. What are integrated markets? Integrated markets are markets where capital can flow easily between two markets. So, for example, if you take the Eurozone market, so the different countries within the Eurozone, countries like Germany, Spain, France, etc. So this would be an example of a very well integrated market, because money flows very easily across these different countries. Then if you take the Eurozone and the USA, there again these markets are reasonably well integrated because money flows relatively easily across institutions in Europe and the United States. And to take another extreme, if you take the India and Pakistan economies, this is not well integrated because money does not flow easily between these two countries. So these two countries, or these two markets, the Indian financial market and the Pakistani financial market, are not well integrated. Another term that you should know is that of direct investing. Direct investing is where an investor directly purchases shares in another country. So as an example, if you have an institutional investor in the US such as Goldman Sachs, and if they directly buy shares of Japanese airlines on the Tokyo Stock Exchange, that would be an example of direct investing. Now this direct investing is not easily available to all investors. So for example, if somebody sitting in Pakistan wants to directly buy shares in India, that will not be possible. So direct investing, you need to understand the concept. Generally it works for institutional investors across reasonably well integrated markets. From an exam perspective, you need to understand what a depository receipt means, and then there are other terms that are subsets of a depository receipt. So essentially a depository receipt allows investors to invest in or indirectly invest in markets other than their home market. The idea is straightforward. Within depository receipts, essentially what happens is we have an institution called a depository bank. And let's take a simple example. Let's say that we have an organization like MCB, which is a Pakistani bank. If a bank such as Deutsche Bank buys shares of MCB, and then against those shares of MCB, they can then issue what's called depository receipts in the London Stock Exchange. So when an investor now buys these depository receipts in the London Stock Exchange, he is essentially getting exposure to MCB. If MCB shares go up, the investor in the MCB depository receipts will benefit. If the MCB share price goes down, then the value of this depository receipt goes down. These depository receipts are generally denominated in dollars. So in addition to the value of MCB shares, another important variable is the rupee-dollar exchange rate. So if the rupee appreciates relative to the dollar, then the investor over here who has bought MCB depository receipts in dollars, he will benefit if the rupee strengthens against the dollar. It's important to understand within the context of depository receipts that you can have what's called sponsored depository receipts and unsponsored depository receipts. Sponsored depository receipts means that the sponsor, in this case MCB, is involved in the process, and unsponsored depository receipts are where the sponsor, MCB in this case, would not be involved. So for an unsponsored depository receipt, it's straightforward. There, the investment bank or the depository bank actually will simply buy these shares and issue depository receipts. So they will simply be buying existing shares of MCB, and MCB is not involved in the process. For a sponsored depository release, for a sponsored depository receipt, the sponsor would be involved and potentially would be issuing new shares and hence raising capital using depository receipts. Another categorization for depository receipts is GDR versus ADR, and this is a simple classification. GDR stands for Global Depository Receipts and ADR stands for American Depository Receipts. If you have a depository receipt in the United States, then that's called ADR. So for example, if an investor wants to buy Japanese Airlines shares in the US, he buys them through what's called a Japanese Airlines ADR. Outside the US, in markets such as London and Luxembourg, we call a GDR a Global Depository Receipt. Actually, in simplistic terms, a global depository receipt simply represents ownership of a share which belongs to a company outside your home market. I will talk about ADRs in a little more detail on the next slide. Just two more terms that you need to be aware of. One is GRS and the other is BLDR. GRS stands for Global Registered Shares, and these are simply shares which are traded in different currencies on stock exchanges around the world. And then we have BLDR, which stands for Basket of Listed Depository Receipts, and these are essentially an exchange traded fund which are a collection of depository receipts. So now let's talk about different types of American depository receipts. There are four types of ADRs: level 1, level 2, level 3 and unlisted or Rule 144A ADRs. Level 1 ADRs are the simplest kind. The objective with these is simply to broaden the investor base, or essentially including US investors in your investor base. With these ADRs, all that is happening is a depository bank is buying shares of, say, Japanese Airlines in the Japanese market and issuing ADRs against those shares in the US market. Hence, with a level 1 ADR, we do not raise any money on the US markets. SEC registration is required. The trading is in over-the-counter markets. What this essentially means is that we have large institutions involved in these ADRs. These institutions buy and sell the ADRs with each other. The ADRs are not traded on an exchange such as the New York Stock Exchange. The listing fees for this situation are low, and the size and earnings requirements do not exist. So you can have a level 1 ADR for even small companies. With a level 2 ADR, again the objective is to broaden the investor base so as to include investors in the US. Here again, we do not raise capital in the US market through a level 2 ADR. SEC registration is required, but trading now includes the major stock exchanges such as the New York Stock Exchange and NASDAQ. Listing fees are high because we are listing on the major stock exchanges, and size and earnings requirements do exist. So a company needs to meet a certain threshold in terms of size and earnings in order to go for a level 2 ADR and hence to be listed on a major exchange. Level 3 ADR is the most complex. Here the objectives are twofold. One, to broaden the investor base, and two, to also raise capital. So here the company is actually raising capital by issuing new shares as ADR. So actually new shares are created or issued by the company, and ADRs are created against those newly issued shares, and hence this is a mechanism of raising capital. SEC registration is obviously required, and these shares actually would trade again on major exchanges such as the New York Stock Exchange and Nasdaq. Listing fees, as you can imagine, are high, and clearly there are size and earnings requirements. So with Rule 144A, essentially what happens is a company can raise money. So let's say that a company in Pakistan wants to raise funds using this sort of ADR. They can simply approach interested entities or interested financial institutions in the US and raise money from those institutions, and essentially give a percentage of the company to those institutions. So the objective here is to raise capital, and this is actually capital only from qualified institutions. So raising capital is yes. SEC registration is not required. There is no real trading that happens over here. The listing fees are, as you can imagine, very low, and size and earnings requirements do not really exist. Now changing gears slightly, let's talk about the risk and return of equities. Briefly on return, when you invest in equities, there are three types of return that you can get. One is capital gains. So if you buy a stock for 50 and it goes to 60 after 1 year, this is referred to as capital gains. Dividends is the dividend that you get. So let's say on this stock you got a $2 dividend, so that represents your dividend yield. Foreign exchange gain happens when you invest in shares outside your country. So if you invest in let's say shares in the United States, and the dollar strengthens against the rupee, then that gain is referred to as a foreign exchange gain. If you are in India or Pakistan, then you are thinking in terms of rupees, and obviously if the dollar strengthens, then from a rupee perspective you are better off, because your asset in this example is in dollars. Obviously when you invest in your own home currency, in your own country and in your currency, then this component of return does not exist. A core theme in finance that you will see over and over is when you take higher risk, you should when investors take higher risk, investors expect a higher return. So when you compare these different kinds of investments within the equities asset class, we need to see what the relative risks are, and then based on that we can set expectations about returns. So when we compare common shares with preference shares, common shares represent a residual interest, which means that common shareholders get paid only after preference shareholders get paid a return. So common shares have a higher risk, so the risk is higher for common shares, and hence the expected return should be higher for common shares relative to preference shares. Within the preference shares category, we have cumulative as well as non-cumulative preference shares. And as described earlier, cumulative preference shares are those where if in a given year dividends are not paid out, they accumulate and are paid subsequently before common shareholders get any money. And clearly that means that cumulative preference shares are less risky than non-cumulative, and therefore an investor should expect a higher return on non-cumulative preference shares. Callable versus non-callable shares. From an investor perspective, the callable shares are more risky because the company or the issuer has the right to call these shares back at a given price. Since these are more risky from an investor perspective, he should expect a higher return on callable shares. Puttable versus non-puttable shares. Again, as a quick recap, with a puttable share, an investor has the right to give the share back to the issuer and get a predefined amount of money for it. So the relative risk is low with puttable shares relative to non-puttable shares, and hence since the risk is higher over here, the expected return should also be higher with non-puttable shares. Equity securities and company value. So some very basic points here. Companies issue equity to raise capital and increase liquidity. So if you have a company that wants to expand, one way that it can raise money is by issuing new shares and essentially bringing on new shareholders. When the company issues new shares, it gets cash and hence the liquidity goes up. Typically, companies issue equity to finance revenue generating activities. So property, plant, equipment, etc. is often purchased using equity capital. And what that essentially means is that typically companies do not issue equity for working capital. Obviously, this is not a hard and fast rule. So we are simply saying that in general, companies use equity money to fund or finance revenue generating activities. Now, the equity itself becomes a sort of a currency for the issuer, because the equity itself can at times be used for acquisitions. So at times you might hear that XYZ company used its shares to buy a 60% stake in another company. So essentially what happens there is a company uses its shares. So a company gives its shares to the shareholders of another company in return for a certain percentage of that other company. So not a hugely important point at level 1, but all you need to know is the shares of a company itself provide the company with a currency that is often used for acquisitions. Through equities also allow companies to do option-based incentives for employees. So what this essentially means is that a company can, for example, tell its offer stock options to its senior management, encouraging them to do a good job, and when employees come back to exercise those options, the company issues shares and gives those shares to the employee. Obviously there is a certain exercise price that the employee needs to pay, but nevertheless new shares have to be issued. We talk about stock options in more details in other places in the curriculum. Now, a larger point that needs to be made here is that management goal is to increase book value and maximize market value of equity. So this point I hope you already know, but just to re-emphasize the distinction between book value or market value. The book value of a company is based on the assets and liabilities. So as you probably know, for a given company we have assets, we have liabilities, and we have equity. And the total value of assets, let's say, is 100. If the value of liabilities is 70, then the book value of equity is simply assets minus liabilities, which is 30. And this book value will be reported on a given date. So on a given date we look at the book value of assets, the book value of liabilities, and then the book value of the company is simply the value of assets minus the value of liabilities. and this typically will change over the course of the year. We will have this number at the beginning of the year and then this number at the end of the year, and to get the average book value during the year, an investor will typically take the average of the beginning year book value and the ending year book value. Now, why does a company management directly influence book value? Or essentially, if management, for example, can increase the value, can influence book value in a few different ways. One obvious way is if new shares are issued, then that obviously will increase assets by raising cash, and that will also increase equity. Management might do other actions that influence net income, which essentially influences earnings. Market value is the value of the company in the stock market. So market value is essentially how much investor is willing to pay for this company. Now, if this company has very bright prospects, then investor might be willing to pay, let's say, 45 million for this company. So the company has a book value of 30, but an investor is willing to pay 45 million. So the better that a company management is doing, or the rosier the prospects of that company, the higher the market value. For a publicly listed company, the market value will simply be the number of shares outstanding times the share price. So very simplistically put, if the book value is going up, market value goes up. But more importantly, market value is a function of what investors expect this company to do in the future. And since the market value is determined by what investors think about the company, management has an indirect impact on market value. So if the management can convince the market that they are doing a good job and the company has bright prospects, then market value will go up. On the other hand, if the market does not have a high opinion of the company or what the management is doing, then the market value will come down. And at this stage, I would strongly encourage you to look at Exhibit 22 in the curriculum, which is on page 193. So this is a short reading, but this is what Warren Buffett says about book value and market value. And any investor should know about Warren Buffett. He is arguably one of the greatest investors of all times. And when you read this exhibit, it will just take you 5 minutes, but I think it is an excellent read. So please go ahead and study that. Now let's talk about accounting return on equity. This is a straightforward concept. Let's say that we are looking at the accounting return on equity for the year 2010 for company X. Now there are two ways to come up with the accounting return on equity. The simple formula for return on equity is the net income in a given year. So here let's say the year is 2010 divided by the average book value for 2010. And the way we find the net income for 2010 is simply the net income generated in 2010. The average book value is simply the book value at the start of the year, book value at the end of the year, and you take their average. So this denominator simply becomes book value start plus book value at the end of the year divided by 2. So this is one method of coming up with the return on equity. And the good thing about this measure is that it's fairly objective. So you can look at the income statement for 2010 and come up with your net income. You can look at your balance sheet for 2009 and the ending balance sheet. So the balance sheet for 31st December 2009 will give you the book value at the start of 2010. Your balance sheet for 2010, so 31st December 2010 will give you the book value at the end of 2010. You take an average of those two numbers, and that gives you the average book value of the year. sometimes you might want to see what was your return relative to equity at the start of the year. So there then the ROE will simply be equal to the net income for 2010 divided by the book value at the start of 2010. So you will see both these methods used, and depending on the context you can figure out what makes more sense. Now a question to ask is whether it is good if return on equity is going up. And the answer is that it depends. You need to see why is return on equity going up. So let's look at the formula again. So formula is net income divided by book value. If you have a situation where return on equity is going up because net income is going up very fast relative to book value, that in general is a positive sign. So in that case it is good that ROE is going up. But another reason that ROE might be going up is that, let's say net income is flat, but book value of a company for whatever reason is going down. So in this situation, the ROE is going up, but it's not a very positive sign. And something else that you have studied both in corporate finance as well as in financial reporting and analysis is the DuPont analysis, which allows you to decompose ROE, and since we've already done that twice, I will not repeat it here. From an exam perspective, it's important to be able to calculate return on equity. Now, why do we do accounting return on equity versus market value calculations? The accounting return on equity is very objective and simple to do. So one should do this. But another caution when one does accounting return on equity is if you are using this ratio to compare two companies, let's say A and B, you need to make sure that both companies are using the same accounting standards, and if they are not, then you need to adjust the numbers so as to bring them on the same level. So if one company is using IFRS and another is using US GAAP, you need to use similar assumptions for both companies or similar accounting related assumptions in order to come up with a ROE that can be compared. And we talked about this concept in a lot of detail in FRA, so I won't spend too much time over here. In terms of market value, as I said earlier, that is much more subjective. So market value is you must calculate it, as you will see in Warren Buffett's little note, but the value that you come up with here is much more subjective and based on a lot of assumptions. Now let's talk about required return and cost of equity. The cost of equity is the minimum expected rate of return that a company must offer its investors to purchase its shares. So when a company is offering shares, investors will buy those shares if they get at least a certain amount of return. Now what's that certain amount of return? That certain amount of return is based on how much risk the investors think they are taking, and this cost of equity is often denoted by the symbol RE, which is the cost of equity, and we discussed this in corporate finance when we were talking about cost of capital, where equity is one form of capital and the cost of that form of capital is referred to as RE. So if the expected rate of return, let's say that when shares are issued, the expected rate of return is 12%, and if this rate of return is not maintained, then the share price will fall. So when the share price falls, then automatically the return goes up, because if you are expecting a certain dividend stream and let's say that dividend stream does not happen, so investors are expecting that on a per year basis they will get, let's say, to make it very simple, investors are expecting dividends of $1, $1, $1, and based on this expected dividend stream, there is a price of, let's say that based on this there is a price of $N. Now if instead of getting $1, it now appears that the amount that will be received is $0.9 or 90 cents, then clearly this share price is going to fall, and we will see this in a little more detail in a subsequent reading. But the general idea is, if a price is determined given certain expectations, if those expectations, return expectations, are not met, then the price of the share will fall. Another important point is, how do we calculate the cost of equity, the RE? And you've seen this before. Broadly speaking, two models are used very often. One is called the dividend discount model and the other is CAPM. At least in level 1, these are the two most important models. In subsequent levels, there will be other more advanced models that you look at. But the dividend discount model, there I'll remind you of the formula. So let's do that here. The cost of equity is equal to D1 divided by price plus G. So this is the current price. D1 is the expected dividend in 1 year's time, and G is the growth rate of dividends. So this obviously assumes that we will have a certain growth rate. So we make an assumption about the growth rate, and we make an assumption about what the expected next dividend is in 1 year's time. So this is the formula for RE using the dividend discount model. Clearly this only works in situations where we have a very predictable and reasonable dividend. Another model is CAPM, where the cost of equity using CAPM is equal to the risk-free rate plus beta, which represents the systematic risk of the stock, times the market risk premium, which is the expected return on market, minus the risk-free rate. And you've seen these a couple of times already, so I hope that this is just a simple refresher. So that brings us to the end of this reading. Please practice as I keep telling you to do so, and you will see some good practice questions in the curriculum. Here, in fact, the curriculum has about 24 questions which you must do, and then do the questions from your study notes. If you like this video, please press on the like button.